All right. Well, welcome everybody, and thank you for joining our side gigs 1099 presentation. My name is Paul Joyeux. I'm one of the co-hosts, and joining me is Ian Dahl.
Well,
Ian and
thank you all for the
Ian
time.
Dahl and I are both wealth advisors at Curi Capital. Collectively, I think Ian and I have been in the business for almost 50 years, helping and supporting our clients. We are wealth advisors. Our role is pretty varied. Our one of our primary focuses is obviously helping clients with all of their investments and choosing and selecting great investment choices. But the other thing that we help with is what we would call the topic of wealth planning. So today, side gigs and 1099s, this is a great wealth planning subject where we can add a lot of value to our client relationships. Today, we're going to go over a number of case studies and a bunch of different topics that I think will be informative. However, before I start, I do want to thank our marketing team and especially Mari Duckler for putting this presentation together because I don't think I would have ever been able to do it on my own. So thank you, Mari. Okay, as I said, we're going to go over side gigs and 1099 income and what are some of the things we can do with this income to help you meet your goals better. However, before we dip into that, let's talk about traditional earnings. So as an example of traditional earnings, Ian and I both work for Curi. Curi sends us a paycheck or it's direct deposited. They withhold taxes. They withhold our 401k, or if you're a physician, your 403b deferrals. That's kind of traditional income. So when we think about side gigs or non-traditional, we're really thinking about you work for yourself. You are your own business. Ian, maybe you can give us some examples of side gig careers or jobs.
Sure. So a side gig, this could be someone who serves on a board as a director. This could be someone giving tennis lessons, someone who owns a landscaping opportunity. We're going to tailor a lot of this to physicians that might be taking independent contractor assignments. They're taking some surgical shifts at a hospital they're not, primarily employed by, but it can run the gamut of anything from, a babysitter up to a board of directors for a Fortune 500 company.
Yeah, that's great. Thank you, Ian. So let's talk about this income. I'm doing something. I'm on a board. I'm a physician. I'm on a board. I have my reg tip for us. Typically, most of these clients have their regular job, their regular full-time job, but there's some other career opportunity that they're engaged in. Again, such as board work where they are paid directly. So this is not W-2 income, this is 1099 income. And by the way, importantly, one of the differentiators from lawn mowing or landscaping versus board, in order to do this, you actually have to report the income. So you could be a babysitter. We actually have a great dog walker. You can do all these things. However, in order to defer money, you need to actually report the income. So let's talk about some of the different options that you can use. And remember, most of these are in addition to, what could be your full-time job. By the way, a different example, before we get into the weeds here, a different example of a side gig could be you own your own company, and it could be a very meaningful company where you're a consultant and you and your spouse are working together in that enterprise. So it doesn't necessarily have to be a small or low income business. So why don't we start in a simple way here? If I've got 1099 income, I can use that income for things like a traditional IRA, a Roth IRA. For calendar year 2026, a traditional IRA, you're allowed to contribute 7,500. If you're over 50, you're allowed to contribute 8,600. And remember, these dollars are in addition to, a traditional 403b or a 401k. Let's move up the scale. What about a SEP IRA? So a SEP IRA is for self-employed people. or persons, a SEP IRA, you're able to defer 25% of this income. And there's some considerations with that math, so you need to verify this with your accountant. But if I had a side gig or a board role as a physician where I were making 100 grand, I could potentially put away 25 grand pre-tax into a SEP IRA. So pre-tax meaning I'm not, that's a tax savings for me. The limit of the SEP IRA is either 25% of income or up to 72,000. As we get more complicated, we can set up, or, on behalf of our clients, you can set up an individual 401k. So I think Ian and I probably share 40 to 50 clients where they have individual 401ks. Remember, if you're over 50, the 401k contribution amount, I think, is 32,500. Um, in addition to the 401k, you can also do a profit share. And remember, if it's 401k, it could be pre-tax, but you could also do a Roth 401k, and you can also do a Roth profit share. So again, with this, if assuming you have enough extra income, you're able to really either defer or put away a pretty dramatic savings into these plans, whether it be Roth after tax or pre-tax. By the way, the total, again, now some of this would assume you don't have a separate 401k, but if I'm doing a 401k and a profit share for myself, the total is, I think it's 78 grand if you're over 50 like I am. So
And Paul,
within that,
if I can just make
32.5 is the 401k, 47.5 is the profit share. So, this gets to be a lot of money. You do need to remember, though, if you're already contributing to a 401k, you can't over contribute, or a 403b, you can't over contribute between the two.
And Paul, if I can step in for just one moment, one important consideration, if you're a very high earner, a Roth IRA has income limitations. If you're making $500,000, you may be phased out from going directly into a Roth IRA. This Roth Solo 401k, there is no means test, there is no income limitation. So even again, in that scenario, babysitter may not apply here, but if you're a cardiac surgeon, you'd still have a opportunity to defer after-tax dollars as the profit sharing component or your personal 401k contribution. So meaningful way to build a additional tax source in retirement.
Yeah, thank you, Ian. Um, So lastly, let's talk about cash balance plans. Cash balance plans or defined benefit plans are, I think, a fancy newer term for what most of us would consider to be a traditional pension. And I think the easiest way to give an example of this is to do a case study with a doctor a client of ours that Ian and I share. This doctor is already has a 401k that he's maxing out every year. He has from his side business. I guess I wouldn't call it a side gig anymore because it's a board position. He has somewhere around 400,000 to 500,000 additional income a year. Now, if he did nothing, all of that income would be taxable to him, with the exception of some of the deductions that we'll talk about in a moment. So what can we do, and what has this client of ours done? He has signed up for a cash balance plan where he is setting up pre-tax dollars into his own pension, and the approximate amount he puts away annually for the cash balance pension is about 150,000 a year. So that's a meaningful deferral that he's not paying taxes on out of his extra income. In addition, even though he has a 403b that he's fully maximizing, he also does an additional profit sharing component, which is just over 40,000. Sorry, it's 47,500 because he's old enough. That he's also contributing, and that is going directly to after tax into a Roth. So again, it's fairly common again, these higher earners, for us to have to be able to put away $200,000 to $300,000 pre-tax or post-tax into a Roth, if that's something that you want to do. And it's a great, it's really a great benefit if you're thinking out of the box as opposed to just accepting the income. So now let's turn the page and talk a little bit about deductions. You also have eligible expenses. When you think about I'm running a business, it's my own business, whether I'm on a board or a lawnmower, you have all kinds of potential expenses. Expenses could include deducting some part of your personal residence for a home office. It could include equipment like your cell phone, printer, car. It could include travel. You have to fly to and from, mileage, etc. And then also malpractice. So whether you're a physician or you're on a board, both of those roles tend to need, typically have additional malpractice insurance. And lastly, I just want to reiterate this. We mentioned this early on. In order to participate in any of these vehicles, you do have to report the income. So my daughter, as an example, has nannied over the last 3 or 4 years. She's making really substantial income. However, in order to participate in these plans, she really needs to report it, so to speak. And I'll leave it at that. Ian, I think the next page is all you.
Excellent. Thanks, Paul. So we've talked about what you can do with some of the income from your side gig to offset some potential tax liability. We're going to spend a little bit more time on how to make sure you're not getting penalties from the IRS or state tax authorities on that income. Paul mentioned, again, this applies to reported income. Paul and I are W-2 employees. We've worked at Curi Capital for many years. When I started, I filled out a W-4 showing how many deductions I needed. As I've got married, started a family, I've made adjustments to that. But all along the way, my paychecks have had some state, federal, and FICA taxes, Social Security, Medicare coming out. If I was wearing the hat of the employer and the employee as a self-employed individual, all of that liability would fall on my shoulders. There wouldn't be any direct withholding. So usually what our clients do in this scenario, they're doing estimated payments on a quarterly basis, just so that they're reporting the income, they're getting a head start. So April 15th comes around and they don't have any penalties from the IRS for under withholding throughout the year. So very easy to do. If you are employed and you have a side gig, theoretically, you could just overcompensate, over withhold through your day job to account for that side income. Gets you to the same outcome. The benefit with the estimated payments, you have up until January 15th of the following year to make that payment. So if you're waiting for some December 31st finalized reporting, you have a better look at the final number leading up to January 15th. But again, something most folks are considering so they're not caught off guard with any penalties on April 15th. And talked about wearing both of those hats as the employer and the employee. So Paul and I pay half of our Medicare and Social Security taxation. Curi handles the other half. If I'm self-employed, 100% of that, which is 15.3% of the income, would fall on my shoulders. So just something, you do get a deduction for half of that as a self-employed individual, but higher upfront cost. There are some ways to mitigate that if you were to run your income through a limited liability company and make what's known as a S corporation deduction. You then have control over how much of your income is reported as a reasonable salary and a pass-through distribution from your corporation. Think of it more like a dividend from a stock you might purchase. So that dividend distribution is exempt from the self-employment tax. So a lot of our self-employed individuals do set this up with their accountant, with an estate planning attorney, relatively inexpensive. There is a little bit of an annual reporting requirement. We think, depending on your situation, worth that burden to mitigate some of that self-employment tax. And then outside of the tax piece, just general liabilities. Paul mentioned that you should have medical malpractice insurance. Even if you're on a board, you would need some professional liability insurance. Paul and I are covered for what we're doing within the scope of our day to day. But if I decided to be in the business of roofing or tree removal, Curi wouldn't cover me for those activities. So I would need to have a separate professional liability policy. A lot of our clients have umbrella policies to, they're in a car accident that safeguards their investment assets from any potential litigation. That generally does not cover any professional liability. So again, whether a physician or a board, member, you should be looking at malpractice or what's commonly known as errors and omissions insurance on the more professional non-physician side. And outside of that, I mentioned LLCs. They do a decent job of limiting and putting up a curtain between personal assets that does not extend on a medical malpractice liability standpoint. So, folks may think they're covered up. It's always a great opportunity to take a second look. If you are working as a part-time physician, you're as an independent contractor, you may be working with a temp or a staffing agency. They may provide some of these protections. Always verify with them what the coverage limits are, what your comfort is. You can always purchase separate policies on the side. And then outside of liability, health insurance. So again, we've had health insurance through our employer for our entire career. If I left Curi, went out on my own, I would not be covered. If you're married, you have a working spouse, you could latch onto their plan, but a lot of folks would have to purchase private health insurance. Is deductible if you're a self-employed individual, but would want to have that just in case something happens to you. We obviously know the rise in cost of medical care in this country. That would be something you would purchase even privately or through a professional agency. The American Medical Association, if you're a physician, could be one place to look. And then long-term disability. So let's say, again, my cardiac surgeon, they lose both of their hands in a car accident. They're no longer able to operate surgery. They want to be compensated for the rest of their kind of working career from a disability standpoint. Very key to make sure you're purchasing what's known as own occupation versus any occupation. That happens and you have no hands. You could still be a professor. You could still consult, give, speaking engagements. They would say, well, you can do other occupations. We're not going to pay. If you had my own occupation, I can no longer be a surgeon. I'll get my disability. And if I wanted to enrich myself further, now I can go and continue giving speaking engagements, be a lecturer, and still have this disability policy, which wouldn't be invalidated by any other occupations. But again, that would not be covered. We have that provided by our employer. Independent contractors would have to purchase this separately. And then again, we spent a little bit of time just on the customization of all of this. We've got some disclosures. Every situation is going to be different. Paul mentioned some of those potential retirement savings plans. Some of those would extend if you had employees. So if you're a single operator, some may be better. If you're employing others, you may want that. You could get additional deductions for your contributions to employees, but depending on cash flow, just something to consider. When we're talking about private practice, that really comes into the fold. So if you're a group of physicians that want to branch off from a hospital, start your own practice, a lot of the tax planning, retirement planning, even risk mitigation strategies can be commingled. You get better pricing. We have a different risk pool. We've got other staff that can participate. My health insurance is going to be lower because I'm pooled in with other physicians, office employees, information technology employees, but that does bring with it some additional just complexity. So the largest would just be business administration. If I'm doing my own independent contracting work, my overhead is pretty low. If I have to launch a business, employ people, rent real estate, lease equipment, deal with compliance, tax filings, finance, that is just additional costs deductible, but things nonetheless that we would need to consider. And then even if we're looking at the structure, there's some complexity there. So Curi Capital is a partnership. Paul and I are both partners. We now have a different tax form we have to wait through every year. We have a Schedule K1 showing what our value in the business looks like if we have distributions. So that is something you're going to have to hire accountants and teams to audit, send out documentation. Every couple of years, you may need to evaluate how much is our business worth. We have new young physicians buying in. What is a fair price for them to purchase in? We've got some folks retiring. What is a fair price for them to exit their equity in the company? And then for key individuals, let's say I'm the CEO of this operation. If I drop dead tomorrow, do the other partners have enough liquidity to buy out my shares? So often what we'll see are buy-sell agreements where they're actual life insurance policies my partners would take on me so that the business can be very seamless, continue operating if something were to happen to a key man or individual.
Hey, Ian, that was really great. Let me, if I may, I want to try to summarize a couple of key points.
Absolutely.
Having this extra income creates opportunity. It creates an opportunity to save more effectively, to create deductions against the income so you're not fully taxed. However, there are a lot of unique nuances with all the different plans that you can use. Some are incredibly simple, some are very complex and require, as an example, an actuary. If you're doing a cash balance pension, those cost more to set up. You need to hire an actuary, et cetera. And then also, Ian, as you pointed out, um, if you're a more than one person organization, if you have three people, four people, or more, or two or more, due to what's called fairness testing, you have a responsibility to offer whatever plan you accept to the rest of your employees, given a bunch of different, rules and regulations. So it's a great opportunity, great way to shelter income, great way to save more. At the same time, we think it makes sense to spend time understanding your choices, have someone like us sit in front of you and run through what are the pluses and minuses or pros and cons of each plan and how it might best uh, suit your goals.
Excellent. And that covers it from the main presentation. I see a few questions in the chat here. So, Paul, I'll take a stab at these. The first question is, what's the right order of operations for my first paycheck? Should I prioritize paying down student loans, maxing out retirement savings, or building an emergency fund? Again, the caveat, every situation is going to be different. In this scenario, though, almost always we would recommend building the emergency fund. If you're laid off, if something critical happens, need a new roof, car goes haywire, having that slush fund ready to go would be our first recommendation. Every situation is different, but generally anywhere from 3 to 6 months of fixed expenses. Build a little bit of discretionary spending into that as well, just so you're not living off of canned beans during that time horizon. But student loans also are going to vary. If they are low interest rate, you think you can make more on the open market with your retirement savings, something you'd want to analyze on what that trade-off would look like. Many physicians are working for nonprofits. They have some loan forgiveness opportunities. There can be some tax considerations. Certain doctors, there are tax exempt paths, some would be taxable. So you would kind of build that into the analysis. How long do I plan to work? What is kind of the break even? The younger you're saving, the earlier, especially when Paul mentioned the Roth, the longer we have tax-free compounding, often the better off you will be. So no time to start like the present, but if the student loans are 8 or 9%, you may want to pay those off more aggressively than overloading some of these retirement vehicles. Paul, anything to add on that?
No, I thought that was great. Let's see. Next question. Do I actually need my own disability and or malpractice insurance if my employer says I'm already covered? I think you'd want to evaluate this with your insurance provider and with the employer's insurance provider. Um, as Ian mentioned earlier, if I have a tree cutting business and a tree falls on someone's car, that's highly unlikely to be covered from an insurance perspective if my main profession is heart surgeon or I'm doing something else with my main profession. So I would just want to make sure and talk to a specialist in the insurance space. I would. And I'd err on the conservative side just to make sure and probably get coverage for both. If I own a business, I want coverage on that business, regardless of what my employer may say. And then kind of a tag along question about should I set up an LLC? Um, the LLC helps with liability coverage. I think as your business gets bigger, you would want, and as you have more income, you would want to set up an LLC and or even evaluate an S corp. Again, that would be something we would partner with an accountant on and help come to the best conclusion or best recommendation for each specific situation.
I think it just depends. If you're doing one job on the side for 5 hours and never doing it again, probably not. If this is going to be a recurring occurrence, you're going to continue doing some independent contracting for 10, 20, 30 years. This I would say is a no-brainer. But if it's just one weekend a year, I'm doing something for 2 hours, I make $500 from that engagement, the complexity and the cost of setting this up may not be warranted.
Great. I think that's it for the questions. Thank you, everyone. Thanks for attending, and
Thank you very
stay
much.
tuned, as I'm sure we will have more of these webinars in the future.